Hello everyone, welcome to you on Think Future Academy channel. Today we will cover the cost categorization. It the process of segregating the company's costs into different categories that gives a fair idea to the decision maker about the spending pattern. Overview. Expenses are the essential expenditures that must be made in order to run a firm. Every aspect of production has a cost. Wages and benefits are used to calculate the cost of labor utilized in the production of products and services. The cost of a fixed asset employed in production is assessed in terms of depreciation. The cost of capital used to buy fixed assets is quantified in terms of the interest expenditure involved with raising the money. Companies are eager to understand their expenses. Many expenses are visible and clearly measured. In such instances, there is a direct link between the cost of input and the quantity of output. Additional expenditures must be assessed or allocated. That is, the link between input costs and output units may not be readily observable or quantifiable. In the supply of professional services, for example, quality is typically more important than quantity, and output cannot be judged just in terms of the number of patients treated or pupils taught. There is no direct link between expenditures expended and output attained in cases when qualitative considerations play a key role in gauging production. Different ways to categorize costs. Costs and production might have varying correlations. Costs are also utilized in a variety of business applications, including financial accounting, cost accounting, budgeting, capital budgeting, and valuation. As a result, there are several ways of classifying expenses based on their relationship to output as well as the context in which they are employed. After this explanation of the many categories of costs, several examples of how costs are employed in various business applications are provided. Different ways to categorize costs. Fixed and variable. Direct and indirect costs. Product and period costs. Other types of costs. Controllable and uncontrollable. Out-of-pocket and sunk. Incremental and opportunity. Imputed costs. Out-of-pocket and sunk. Fixed and variable. The two basic types of costs incurred by businesses are fixed and variable. Variable costs change with production, but fixed costs do not. Overhead expenses are another term for fixed costs. They are incurred whether a company produces 100 or 1,000 widgets. Fixed expenses in budgeting may include rent, depreciation, and supervisor wages. Property taxes and insurance are examples of manufacturing overhead. These fixed expenses stay constant regardless of production changes. Variable costs, on the other hand, adjust proportionally to changes in production. Labor and material expenses are often variable expenditures in a manufacturing plant that rise as output volume rises. Because it requires more effort and material to create more output, labor and material costs vary in direct proportion to output volume. You can follow the below figure for understanding. Fixed and variable. The usual separation of expenses into fixed and variable costs does not work for many service firms. Variable costs have traditionally been characterized as labor and materials. Labor in a service business, on the other hand, is frequently compensated by contract or by managerial policy and hence does not fluctuate with productivity. As a result, it is a fixed expense rather than a variable cost for these businesses. There is no clear and fast rule on whether category, fixed or variable, is acceptable for certain expenditures. At one firm, for example, the cost of office paper may be considered overhead or fixed costs since the paper is utilized in administrative offices for administrative functions. That same office paper may be a variable cost for another firm since the company offers printing as a service to other businesses, such as Kinko's. Each firm must assess whether an item is a fixed or variable cost to the business based on its own use. Certain expenses are classified as mixed, in addition to variable and fixed costs. That is, they include both fixed and variable expenses. In certain circumstances, the costs of monitoring and inspection are treated as a single cost. Direct and indirect costs. Direct, Direct costs are the expenses a business incurs directly to make a product or service or buy a wholesale product for resale. Direct costs are expenses that a company can easily connect to a specific cost object, which may be a product, department, or project. Indirect costs are the costs of running a business and going to market with a product or service, regardless of the volume manufactured and/or sold. You can follow the below figure for understanding. Direct, variable costs are equivalent to direct expenses. They can be directly linked to output production. Direct costing is a method of valuing inventory that is also known as variable costing. Only costs that fluctuate directly with the amount of production are charged to items as they are made under this accounting approach. Inventory value is the total of direct material, direct labor, and all variable production expenses. Indirect, in contrast, indirect expenses are equivalent to fixed costs. They are not directly proportional to production volume. Supervisors' pay, indirect labor, factory supplies consumed, taxes, utilities, depreciation on building and equipment, factory rent, tool expenditure, and patent expense are examples of indirect expenses in a manufacturing facility. These indirect expenditures are often known as production overhead. All indirect expenses in manufacturing overhead, as well as direct costs, are included in computing the cost of inventory under the full costing or absorption costing accounting approach. They are regarded as a component of the manufacturing cost. Product and period costs. Product and period costs are analogous to direct and indirect costs. Product costs are those that are directly associated with production in the firm's accounting system and are used to value inventories. Period costs are attributed to the current period as expenses. Period expenses are not considered costs of the items being created in direct costing, hence they are not related with inventory valuation. Yet, if the company employs a comprehensive cost accounting system, all production expenses, including fixed manufacturing overhead costs and variable costs, become product costs. They are considered part of the manufacturing cost and are charged to inventory. Other types of costs. These are the basic types of costs as they are used in different accounting systems. Controllable and uncontrollable. It is helpful in budgeting to distinguish between controlled and uncontrollable expenditures. This basically implies that budgetary managers should not be held liable for costs over which they have no control. Controllable costs include such items as marketing budgets and labor costs, over which the company has full authority. In contrast, non-controllable costs include things like rent and insurance, which a company cannot change. To maintain profitability, management must know the three reasons to differentiate between these two cost types, including efficient management. By focusing more on controllable costs, management can proactively, and more quickly, react to the information that financial statements disclose. Effective cost monitoring. Financial statement does not present raw numbers, it is the organization's financial scorecard. A financial statement that separates controllable costs from non-controllable costs gives management a clearer picture of the entity's financial health. Such a statement also allows management to compare monthly or annual trends and quickly pinpoint any unusual patterns. Incentive packages. In some industries, management is paid according to a profitability split. Therefore, keeping a manager accountable for controllable costs, and unpunished for what he cannot control, makes sense. If a company's financial statements clearly define expenses and their impact on profitability, then team members can more easily understand the incentive packages. Out-of-pocket and sunk. While analyzing the financial advantages of specific projects, financial managers frequently employ the ideas of out-of-pocket charges and sunk costs. An out-of-pocket expense is a payment you make with your own money, whether or not it is reimbursed. Out-of-pocket expenses are those that necessitate the use of immediate resources, typically cash. Already, sunk expenses have been incurred. Financial managers, for example, may consider the sunk costs connected with equipment and machinery, as well as the out-of-pocket expenditures related with adding more material and personnel, while deciding whether or not to boost output. Examples: ticket, education for staff kids, research, new software installation or equipment, benefits or facilities expenses, deductibles, co-insurance, and co-payments. Incremental and opportunity. The notions of incremental and opportunity costs are used in financial planning. The expenses of transitioning from one level of activity or course of action to another are known as incremental costs. The difference between two choices is represented by incremental costs. When the means of production are employed for one activity rather than another, or when cash is used for one investment rather than another, opportunity costs are incurred. Nothing can be created or invested without a cost of opportunity. When one investment or production choice is made with limited resources, the potential to employ those resources for another reason is lost. As a result, opportunity costs are rarely considered in investment and production decisions affecting resource allocation. Incremental cost is the total cost incurred due to an additional unit of product being produced. Incremental cost is calculated by analyzing the additional expenses involved in the production process, such as raw materials, for one additional unit of production. Understanding incremental costs can help companies boost production efficiency and profitability. Incremental cost is the amount of money it would cost a company to make an additional unit of product. Companies can use incremental cost analysis to help determine the profitability of their business segments. A company can lose money if incremental cost exceeds incremental revenue. The value of what you lose while deciding between two or more possibilities is known as opportunity cost. When you make a decision, you believe that the outcome will be better for you regardless of what you lose by doing so. As an investor, opportunity cost implies that your investment decisions will always result in current and future losses or gains. Managerial accountants understand that when presented with two or more possibilities, incremental costs are those that vary depending on which option is chosen. Assume you wish to get a new car. The incremental expenses of purchasing the mobile comprise the car purchase price plus any extra accessories purchased. You'll also have to pay for fuel and tolls to get to and from the showroom, which is an additional cost. The cost of buying lunch after purchasing the car, on the other hand, is not an extra cost because you have to pay for that regardless of whether you buy the car, and accountants know there is no such thing as a free lunch. Choosing one option may mean you lose money because you turned down another alternative. These incremental costs are called opportunity costs. For example, say you choose to take the day off from work to go bike shopping, losing $100 in income. That lost income is an opportunity cost. When considering decisions to invest in long-term projects, one of the most significant opportunity costs is how much you could have earned by investing your money elsewhere. Imputed costs. Imputed expenses are also useful to financial planners. These are expenses that are linked with internal transactions but are not actually incurred. A technique of transfer pricing may be required for financial reasons when work in process is transferred from one department to another within an organization. While no items or materials are purchased or sold, the receiving department may be charged with imputed costs for the work received. When a business rents a structure that might have been rented to a third party, the rent may be considered an imputed cost. Today we discuss the different types of cost only. In next video we will understand the business application using different of cost.
I hope you enjoyed this video, and before leaving, if you have not already subscribed this channel, make sure to subscribe, like and hit the bell icon to get updates when I post new videos. Provide your feedback in comments. You can download material from the below links under video.